This one is the microphone.
Okay.
Yours is off now.
Okay.
My question is solar and wind in the energy world going forward.
I guess I have to take that one.
You got the mic.
I said something about energy, right? So I don't know if you can see my socks. Does this work? Is this on? If I took my shoe off, you could say it's no lie I make things up. Or it uses slightly different words, but solar and wind. The price of natural gas is really low. We've got a lot of it. So I think it's a real challenge for the economics of the solar and wind industries. That said, each state, not all states, but most states have clean energy requirements, and so there's each year that goes past has larger and larger amounts of required contracted clean energy that needs to be produced. So solar and wind will be here for the rest of our lives, and our children and grandchildren's lives as well. But I think we're also going to produce a lot of electricity, if not most of our electricity, from natural gas. Right now, it did take over from coal as the leading source of electricity production last year. I think coal has just taken it back, the leadership, but if you want to call it that. But for now, I think natural gas will continue to increase as the primary source of electricity production.
People ask about, is this still working? People ask often, what is the future for, for the energy sector if we're at peak demand for energy? We was talking about peak supply years ago, right? 10 years ago, oh my God, peak supply, oil was up $180 a barrel. Now we're concerned about peak demand as countries like China become a lot more efficient, right? Talk about massive electric fleets and these types of things. Are we indeed at peak demand? And if so, wow, what's a big energy integrated company worth? And I think the interesting thing, if you look at how these companies are valued, they're still spending a tremendous amount of money on exploration. It's very expensive. If you just valued, I'm just as an example, not to pick a stock as a buy or sell or anything, but take a look at ExxonMobil. The thing is, Exxon trades, I think the market cap is around $375 billion. It was about a week ago. If you valued it just on its reserves, it'd be worth twice as much. But it's spending so much money to find new stuff, and it's so expensive. What if they didn't do that anymore? What if 100 years worth of proven reserves in the ground is more than enough? All of a sudden, you take a look at that company at a very different perspective. They don't spend so much money on exploration anymore. And you look at them maybe like the tobacco companies when they couldn't advertise anymore. Advertising was expensive. They've become just cash cows. And the valuation of tobacco stocks, jumped sevenfold. It's not the end of the energy sector. If at the end of oil, if we're just running at peak demand anymore. There's an interesting story there in taking a look at some of these companies. There was a deal BP did, I think, a year or two back, valuing proven reserves in the ground at about $25 a barrel. If you valued Exxon that way, it'd be worth about $500 billion versus the $375 it's trading at right now. So we all in this room could take it private, turn a quick $125 billion profit. Who's in? So I just bring that up to say, David's right. I think, long term, the prospects look very good for the alternatives, but it doesn't necessarily mean the fossil fuel companies are destined to just whoosh, and the energy sector is going to implode. There's potentially quite a bit of value there if these companies are restructured for a future that looks quite a bit different from an exploration perspective than in the past.
One point I'll bring up, maybe slightly a counterpoint, but if you look at the work that's in the rapid advancements in technology that are being made in terms of batteries, so you look at Tesla, for example, it's fascinating what they're doing. And also the amount of energy that they can capture via solar is pretty fascinating too. So they're really optimizing that. So and you think about autonomous cars, and Tesla's about to put out the first 18-wheeler autonomous vehicle, full electric. Interesting. One of our guys visited the Gigafactory in Nevada. So that's Tesla's, that's the battery factory. It's the largest freestanding structure by volume in the world. And it's interesting on the tour, so they give a tour of the whole space, and halfway through the tour, the guy from our team raises his hand like, hey, I have to go to the bathroom. Is there a restroom somewhere around here? And the guy looks at him like he has two heads like, sir, there's no bathrooms in this building. There's no humans that work here. It's all robots, right? So yeah, so you think about, the economy is dramatically changing, transportation is dramatically changing, manufacturing is dramatically changing. There's no turning back on that. And the level of efficiency that we can capture and store energy in terms of batteries is improving at an exponential pace. So I think that has huge implications.
What happened to the guy that had to the bathroom?
So yeah, I know.
Next question.
So I have a pretty good understanding of what's going on in the equity markets and also what the Fed is doing to kind of manage monetary policy. I guess my bigger, at least in the short term and the midterm, is what the Trump administration is doing. I'm not really sure whether they're causing growth or they're not causing growth, and what the long-term implications are. It seems like.
So I'm holding the mic. I'll answer from a fixed
Probably
income.
all have things we want to say.
Yeah, I'll answer from a fixed income perspective. Obviously, we're any type of constructive fiscal policy to be implemented. I think that's huge in terms of from an economic growth perspective, particularly the corporate tax rate. If you were to reduce that, and obviously, repatriation, I think could have huge implications as well. The market's not really pricing much of that, particularly from a bonds perspective. So, I think what could surprise us if we did get anything from that side, it could surprise markets, particularly the bond markets. But from a fixed income perspective, what keeps us up at night in terms, and one thing I'll also highlight, despite the lack of legislation being passed, if you look at small business optimism, it's literally at its peak. So when you think about velocity of money, that has huge implications. If you're more confident in your business, more confident about your future, more confident about hiring, create more jobs, you're spending. So as a forward-looking indicator, small business optimism is actually a pretty strong forward indicator. So despite the lack of legislation, there actually has been some interesting real economic implications. And the other thing we think about as bond investors, obviously, is the composition of the Federal Reserve going forward, and that's the huge question mark. So if he were, and a lot of the concern is if he were to put in place someone that's quote unquote more hawkish, meaning they're going to raise rates at a much faster pace, that could present challenges to the bond market and to equity markets for that matter, and to the economy. We don't think that happens. We think, likely the next chair of the Federal Reserve will be a continuation of current policies, very moderate pace. So, two angles from a bond perspective.
I'll go next. I'll keep it brief because I don't know what the Trump administration is really trying to do. I think I think the world thought, the financial world at least thought when they got elected that there was a pro-business, pro-deregulation, I guess anti-trade, or you could put it in different terms if you like, but a sort of an addressing of the problem that global trade has really hollowed out manufacturing in lots of communities and states across the U.S., which I don't think we've ever had a policy really to deal with and address those types of issues. So I think we started off in that direction, or at least that's what everybody expected. For the first 3 months, you saw interest rates rise significantly. Right after the election, you had the what do they call it, Trump bump for a while in the stock market, and the market has continued to rise today. The bond market is quite skeptical that much is going to get done. Rates are back down again. Yes, the Fed is increasing rates. The Fed keeps talking about mythical things like inflation, which there isn't any of, but they keep saying that they're data dependent, and if you're really data dependent, they wouldn't have done anything. So, where we are today and what we should expect, the ability to deliver on actual reform and policy issues is tough, right? We found that out in the previous 8 years. It's okay to talk about wanting to do certain things, but it's really hard to get Washington to move. There's a lot of sand in the gears. There's still sand in the gears today. And relationship between the president and his own party in Congress isn't all that good. So I think you need some solidarity amongst those groups or some solidarity across the aisle in order to get anything done. And I think we've seen some examples that might cause some optimism on things getting done, but I think you'd be perfectly rational to be very skeptical that meaningful reform will get done.
Ignore it all. It doesn't matter. None of it matters. Look, the tweet, I don't know how many are in social media, but I tweeted at the beginning of this year, I said, look, the biggest political risk for investors in 2017 is to put too much emphasis on political risk in 2017. Economics and markets have a way bigger impact on politics than the other way around. People think it's politics affecting markets, affecting the economy. It is way the other direction. And we've got this relationship backwards. And I think if we went into another recession, in a downturn, you would see different things coming out legislatively. But the fact is, things are going well. There's no impetus for any change. We're not seeing much in the way of change. Shayan mentioned, regulatory change as opposed to legislative change being positive, or the lack thereof being more positive for small businesses. You could ignore this stuff. Politics, red herring for 2017-18 as well.
We have time for one more question.
Oh, two.
Okay, I got one here too.
So,
Just some thoughts on the U.S. dollar.
Has it been weak this
Here, do you see the weakness continuing, and any investment implications?
Sure. So real quick on the dollar. So everybody expected at the beginning of this year the dollar was going to go up. Why wouldn't you? If cash yields are higher, the world puts its cash wherever they think it's going to get the best yield. And the idea was, hey, the U.S. has not only got a better yield than Europe or Japan, it's going to be going up. And then the Fed wasn't as swift in raising interest rates. And the fact is, if you looked at the futures markets, everybody was betting on it. We've now gone from as bullish as traders were on the dollar at the beginning of this year. They are that bearish in the last month or so. No surprise that the dollar stabilized a little bit here. So a bit of a shock there seeing that move, but it's a little bit because the market was out of balance. It's now out of balance the other way. Our view is a modest move higher in the dollar, a few percentage points over the course of the next year. Not something you need to brace yourselves for, not something you're going to see a huge swing in terms of currency translation on earnings or anything like that. But it's been a pretty powerful move, and it's really been because of dashed expectations on many rate hikes from the Fed this year that were priced in the beginning, and just the fact that so many traders were positioned the wrong way. Currency is very driven by trading, and you tend to see those kind of things. So yeah, a little bit of an upward move, not nearly as dramatic a move in the dollar. The market, I think, is pretty well balanced with regard to what it expects the Fed to do. Maybe the Fed's going to surprise them, do a little bit more than that over the course of the next year. But David, I imagine you disagree with that given your outlook on inflation.
Yeah, I think the Fed's going to be slower. But back to the currency issue, I think it's always fascinating in the currency markets that anytime you get a meaningful move in a currency or a series of currencies in one particular direction against the dollar, such as the euro fell materially 2015, 16, and then has done very well this year. I think the market always extrapolates those moves and assumes that the dollar is going to keep going in one particular direction. And every time you get a meaningful move in a currency, it's redressed a lot of the reasons why it moved in the first place. And so it can be sort of it sort of moves in the opposite direction of economic forces move in the opposite direction of that move continuing. So I think part of this year's move was. Versus 12 months ago, maybe we had an expectation that Europe was still in recession and with some chance of deflation. And we had negative interest rates out to the 10-year across many different European countries. And today they're positive, and they have positive inflation. So the differential between Europe and the U.S. Narrowed significantly, causing money to move back overseas.
I agree.
so, Mr. Morgan, I hear you saying diversification is the best way to reduce your risk now. I hear Mr. Hussein saying that interest rates are going to stay low because of demographics and technology, and they're not yielding a very attractive return right now. So where do you see the best and I see global markets increasingly strongly linked and correlated. So where do you see the opportunities for diversification?
Well, it's gotten harder, but I think the moment you step away from the stock market and put money into higher quality fixed income, you have a contractual right to get your money back at some point in the future. So basically, if the credit research has been done appropriately, then you have a lot more stability in your investment, and that gives you some ballast stability in your overall portfolio. You can find fixed income investments that also have a tendency to move in the opposite direction of the stock market. Doesn't always happen, but there are parts of the longer duration end of just pure US Treasuries that have a very good record of moving higher in price in periods of stock market volatility. I wouldn't say necessarily expect that every time the stock market sells off, but that might be something that to consider. If we're just looking for other things that you can put in your portfolio that can give you a reasonable rate of return, and you should expect your money back. In the taxable fixed income world, preferreds have had a great year. They had a great year the previous year, and they've done very well for 7, 8, 9 years now. But they still have value relative to a number of other sectors. Dividend yield over 5% with some tax preference to that. So not a bad investment. And we feel that there are parts, similar to what Shayan said, I think there are parts of the municipal market that offer value as well. Although thinking at 3-5 years in the municipal world, I would warn that there are many states out there that have rising problems and an inability to get their political systems to deal with those problems. So states like, I actually live in New York, not Connecticut, but Connecticut's got a lot of problems. Governor Christie in New Jersey has not dealt with any of the issues that he really needed to there. So there's some states where there's some growing problems that will need to be dealt with that you need to be aware of in your municipal portfolios. But there's also a lot of volatility, illiquidity that can be turned to your advantage, I think, in the municipal world with the right investment managers.
Either one want to chime in on that? No? Okay, we're gonna hold for there for a moment. We're gonna break for coffee and to chill out for a little bit. I want to throw a couple more things to you. We couple things that are going on at Lexington. We have an Empower Women series, which was new this year. Christine and Jordy headed it up, along with other key members of our team. And that group meets on a monthly basis, usually right at Lexington Wealth Management, right in our offices. And the topics are varied. Guys, you're not welcome. For now. I'm working on it, but I'm not making much progress. I have to tell you that much. Trying to get transcripts, it's difficult. But I think that's been a really, really good thing for a lot of people. And it's a safe place for women to meet, talk, and the topics are varied, from some very heavy topics to some lighter topics. We are starting another series January of this year. It's called The Entrepreneur's Wallet. And a number of you that are entrepreneurs, that know entrepreneurs, they think of money a little differently than a lot of people who are not. And oftentimes they're starting businesses, utilizing credit cards and all kinds of things to get a business up and running and moving. They're not necessarily maxing out 401k contributions and the like. Their goal is to build a business, ultimately sell it someday. So we're starting to interview a number of entrepreneurs that we're friends with to get their opinions, and we're doing video casts with Jordy and myself. And then we're talking to some of the folks that serve some of these entrepreneurs. So that's going to be taking place more in 2018. So there's a couple of initiatives we're working on. We're having a lot of fun here at Lexington. I always appreciate your feedback. After this ends, you'll have the ability to give us feedback on today, what you liked, what you didn't like. And we're going to do something again probably not too long from now, but we do 2 or 3 bigger events a year, then a series of small events. And we try to have fun with it all. If you're not having fun, we should all go home, right? So this to me was a blast hearing from the 3 of you. I really enjoyed hearing different perspectives. There was some agreement, some lack of agreement, but that's what I really, really enjoyed hearing from all 3 of you. And guess what? I wish politics could be like this. It was collegial, wasn't it? So Thank you, gentlemen. You guys all did a great job. I want to thank BlackRock, Schwab, as well as Roboton for helping with this evening's event. Thank you, gentlemen. Thank you.
Thank you.